In this video, I want to talk about 3 undervalued stocks to buy now. These stocks have dropped and I think they are now in a buy range. I think the risk-reward opportunities for these 3 stocks are great, and I think if you buy right now, you increase your chance of outperforming the market. Very good opportunities. We will start talking about MSCI. Full disclosure, I own MSCI and I want to buy more MSCI. So I'm very happy to see the stock price drop, and now the stock price is almost at the April lows. So in this video, we'll just comment a little bit on what is happening with the MSCI and the fundamentals, and we will do some DCF. I will show you the valuation, the price targets, the intrinsic value I have for MSCI, and we'll do the same exercise for the 2 other ones. Okay, in case this is your first video from this channel, welcome. My name is Christophe Noor. I've been investing in the stock market for almost a decade now, and I have achieved a performance of 25% per year. And I only buy stocks when I think I can make 20-25% returns on these stocks. And I believe these 3 companies that are going to talk about today are in this situation. Meaning you have very good opportunities, very good chances of outperforming the market if you buy MSCI right now. So let me talk about MSCI first. In case you don't know this company, they are famous for having the MSCI World Index. More than half of the revenues for this company come from the index segment. So similarly, you can have a benchmark with the S&P 500 or the MSCI World. You have an AUM, and MSCI takes a little bit of a royalty for all the AUM that is linked to this MSCI World Index, for example. You have the MSCI World Index, but you have many other MSCI indices, custom indices, ESG indices, and many funds are working with MSCI. And every month, every year, if you benchmark your fund with an MSCI index, you have to pay a fee. You have to pay a royalty fee. So MSCI doesn't have a lot of cost for this reason, right? We are in the royalty business, asset-based fee business. So that's for half, a little bit more than half of the revenues for MSCI. After this, 20-30% of the revenue, that's analytics. If you are a fund manager, you have a software, you want to track your risk metrics, for example, on a daily basis, MSCI is giving you all the tools through its platform, MSCI One. And as a fund manager, as a wealth manager, you know how to see these kind of metrics, this risk, right? MSCI is giving you the software. And the remaining part of the revenue, that's a little bit of ESG. If you are a fund manager, you know about ESG components for the stocks you invest in, for example, and also private equity. Same thing, data analytics. By the way, if you want to become a better investor and improve your performance, I have a coaching program. It gives you the exact method I've used to generate 25% per year for almost a decade. More on that at the end of the video. And MSCI is in the lucky position of having the index segment, the biggest segment, that is the most profitable one. So you have extremely high margins for this business, almost zero costs, which allows the company to have gross margins of 80%. You don't have a lot of businesses with this kind of profitability. Operating margins of 50%. We are talking at the same level as Visa and MasterCard. And over the past few years, margins have improved. This company has gotten more efficient. Now I'm on Stock Unlock right now. In this video, I will navigate between Stock Unlock and Fiscal AI. You can use the links in my description. I have affiliate links, so it will get 10 or 15% cheaper. You can use my links to use these websites to navigate the same way I do. And if you look at the margins for MSCI, look at this. You have sustained high gross margins of 80% for MSCI. What about operating margins? Sustained and increasing high operating margins from 34% operating margins 10 years ago to now 54%. So this business is literally printing cash. And this business is the backbone of the economy. Many fund managers are forced to use their services. They are locked because they've been using the same benchmark for years and years. Okay, so in terms of profitability, this is just simply amazing. In terms of return on equity, return on assets, return on invested capital, we are very, very good here. If I scroll down here, you see the revenue growth. We are in the definition of up and to the right. Same thing for net income, up and to the right. Same thing for the free cash flow. Look at this in blue here, up and to the right. Actually, everything improved since MSCI got an activist in 2014, 2015 called Value Act. And Value Act forced MSCI to reward shareholders using a little bit of debt with buybacks. So since 2015, the company got a little bit of debt and they started a buyback program. So we are, let me do a quick reminder, a business with a huge moat, with a lot of stickiness from your customers, very high profitability, and the company is focusing on its cash cow, the most profitable segment with very high margins, and they love the shareholders and they reward the shareholders with buybacks. We are in the sweet spot of my investment style. Definitely a sweet spot. And now that the stock has fallen, we are at a reasonable valuation. I think it's a pretty good buy. And I think I will continue to buy this stock as it goes down. Let me continue with the growth rates so you understand better the kind of company this is. Let me show you the income statement. This is it. Let me show you for the past 10 years. 10 years for stock unlock for the revenue. For the past 10 years, look at the revenue growth. The CAGR, the compound annual growth rate, is 11%. So beautifully compounding the revenue at 11% per year. What about the EBIT, the operating income? You have a growth rate of 16%. The difference between the revenue and the operating income, that's what I showed you before. The margins, the company has gotten much more efficient, much more profitable with time for the past 10 years. So you have an EBIT operating income that has grown 16% per year without cyclicality, without seasonality, without the ups and downs, without drama. Look at this. We are literally in a definition of up and to the right. What about the net income for this company? The net income has grown at 19% per year. Again, you have 16% growth rate for the operating income, 19% per year for the net income. Literally, profits have grown at 20% per year. Okay? Now you add a little bit of buybacks to the equation. You reduce your share count by 3% per year. That gives you a diluted EPS, earnings per share, CAGR of 24%. This is a sweet spot. A company that knows what they are doing. A company that wants to be more efficient with time. They have done so for so many years. They had the same CEO for more than 30 years now, focused on shareholder returns. They've got an activist that forced them to be more shareholder friendly. They are successfully shareholder friendly, and they are growing earnings per share at 24% per year. How green do you want the flags to be? That is the definition of having a green flag when you are in an excellent position, in a competitive market, you have a moat, and you are growing your earnings per share at 24% per year. In the very long term, stock prices will follow earnings per share. If MSCI can continue to grow earnings per share at 23-24%, it's very likely, very, very likely, almost certain that in the long term, the stock price will grow at 24%. So we are definitely inside my sweet zone, sweet spot of companies to buy. And this is why I'm making this video, because I want to buy more. And what about the cash flows? You will have the same thing. Free cash flow is here. Free cash flow for the past 10 years growing 17% per year. And I can show you the free cash flow per share. You will find exactly the same thing. No, that's the DCF. Free cash flow. Let me go to the free form. You will find exactly the same thing. The free cash flow per share of this company is just north of 20%. Free cash flow per share. Here we go. The free cash flow per share for the past 10 years has grown at 22% per year. In the very long term, stock prices, we follow the earnings per share, we follow the free cash flow per share, okay? The only thing that you have to monitor is the price paid. What is the price paid? What is the valuation? This is the forward price to free cash flow for this business, okay? If I look at the average and the median for the price to free cash flow, this is what we find. You have an average median of 31 for the past 10 years. Now, the forward price to free cash flow is at 27. We are at the same levels we've seen during the panic of COVID, March 2020. We are at the cheapest valuation we've seen for the past 5 years since COVID. And now, as we have more inflation, you will have more assets, more AUM, because literally the world is printing money. In dollar terms, in absolute terms, the financial AUM will go up, and MSCI will take a royalty fee on this AUM. So actually investing in MSCI is a real hedge against inflation, because if numbers go up from there, if we have more inflation, assets prices will go up, the AUM will go up, and MSCI will make more money. Because if the AUM of the world doubles, the AUM of money that follows this index doubles, the revenue will double. And now, the stock has fallen substantially. In the past, they just created this ESG segment. The forward price to free cash flow at the time in 2021 was 40, was 50, 55. Very expensive. And then the company slowed down a little bit. The ESG segment that thrived during COVID started to fall again. So now expectations are not the same. And the forward price to free cash flow has gone down from 54 to 27. We are now at a very reasonable, rather cheap valuation, I would say. And this is exactly the same thing for the forward PE ratio. We are in the situation where the company converts all the profits to free cash flow. Look at this. For the past 10 years, the average and the median were 33, 34, 35. We are now below 30. So the company is at the cheapest valuation we've seen since the COVID lows. Even in 2022, the company was not this cheap. So maybe you are asking, okay, Chris, maybe the valuation is down because the markets are seeing something, because the growth is not the same, because they are having problems. Fair enough. The company is having temporary problems because the ESG segment is not growing as much. But the ESG segment was only 10-11% of the business. So actually, the slowdown we are seeing right now is a little bit irrelevant. We are seeing a slowdown for custom indexes a little bit irrelevant. I believe the problems the company is having right now are temporary. And if you don't believe me, you can go to Investor Relations here on Fiscal AI and listen to their general meetings. Listen to the talks from the management that are very confident and happy to grow double digits. And they think they can continue like this. They will focus on profitability, more efficiency, and for their, golden goose, the index segment, they want to grow again. And in the latest quarterly report, this is exactly what they've done. For the other segments, they improve the margins. And for the index segment, they want growth. This will lift the overall margins for this business. So in the next few years, I think margins will continue to go up. I think this business can grow double digits. And the management thinks the same. Because very recently, I think it's here in September. Yes, exactly. The company recently increased the debt, $1.25 billion of debt, and they are already using the debt to do buybacks, to do more buybacks. So now the stock has gotten cheap, and the management is literally walking the talk. We are cheap, we are confident, we take more debt to do more buybacks. So shareholders will be very happy. And you know, mathematically speaking, how it works. If you do more buybacks, you reduce your number of shares, so the earnings per share will go up. Another bullish sign for the company. And if you want to know more about how they think about buybacks, you can read this transcript, you can listen to the call. If you use Fiscal AI, it's very easy to do so. You just click on play here and you will be able to listen to what they are saying. And the CFO here, Andy, is talking about the attractiveness of the stock right now. They are literally thinking they are cheap and they are under leveraged. So yeah, the debt is not a problem. The debt is what you have a net debt to EBITDA that is quite low, on the low end. Profitability has improved. The company has not issued new debt since 2022. They are very smart with their debt management. And now that the debt has gotten cheaper and interest rates will go down, I believe MSCI will benefit. If the Fed cuts rates, debt will become cheaper. And debt will become cheaper. MSCI will take more debt to do more buybacks. They are literally under leveraged right now. If you look at their ratios, they are below their ratios. So they want to take on more debt. So they want to do buybacks. So they want to increase earnings per share. And this is not priced in this market. Not a lot of analysts on Wall Street are thinking this way. Okay? So it is not priced in, and I think we have a very good chance of having a good surprise for the next earnings report. Nobody knows, right? Maybe they will fail, maybe they will miss, maybe they will find other problems. But it's very likely that the business will be fine in the long term. And if there is a weakness for the next earnings report, I will buy more for sure. For sure. Okay, so if you want dividends, this company is giving you a dividend yield of 1%. If you want buybacks, that's fine. Now let me talk about the DCF. What was the free cash flow growth for the past 10 years? We said free cash flow for the past 10 years, the growth rate was 18%. 18%, 17%. Okay, let's be conservative and let's put 15% growth in free cash flow for the next 5 years. Okay, we are doing a DCF, so we are forecasting the growth rates for free cash flow. How can you elaborate? How can you guesstimate what will be the growth rate for the free cash flow? Well, you can look at the past. You look at the past, and because of the resiliency of the business model, because the lines are all up and to the right, you can estimate with the very good conviction what will be the growth rate in the future. And I am assuming free cash flow growth rate of 15%, being a little bit conservative. Next question, what was the buyback program? How many shares did they reduce for the past 10 years? They reduced the shares by 3%. So maybe you want to be conservative and you put 2%. So they will do a 2% buyback every year. If these are your estimates, dividend growth rates, I'm putting 0 here. What is your price to free cash flow? Well, now we said that the forward price to free cash flow was what, 27, something like this. Yeah, and ratios, trailing, let me show you. Price to free cash flow now 28. Okay, fair enough. What has been the average? Median, 32, 33. So for the price to free cash flow, let's put a normal multiple of 30, which is reasonable, which is really reasonable, I would say. Price to free cash flow here. You look at the past 10 years of this business, even before COVID, you had a valuation between 25 and 30, okay? So if you put 30 and you think the free cash flow will grow at 15% per year and you think they will do 2% buyback, these are your estimates. If these are your assumptions, the stock is 40% undervalued, 40% cheap. The fair value is $750. And if you buy right now, you can expect a CAGR of 17-18%. pretty good too, and chance of outperforming the market. You don't find many simple, efficient opportunities like this, right? If you want to be more conservative and you say the valuation will drop a little bit to 25, these are your estimates, okay? You don't have a big scenario of this happening. 25 is, I would say, very cheap for MSCI. If you have a price to free cash flow of 25, the fair value is still up. The stock is cheap by 17%. And if you buy right now, you can expect a CAGR of 13-14%. Okay? Now, if you use exactly the past as an indicator, if you say the price to free cash flow of 22, 23, 32, 33. If you use the past as an indicator, saying the CAGR of buyback will be 3%. And if you think that the past is a good indicator of the future and the free cash flow will continue to grow at 17%, we are now at a very, very bullish scenario. So if they do exactly like they did in the past, if the business goes in the same growth rates without being conservative, these are your estimates and this is your value, your intrinsic value. If you believe this is what will happen, the stock is 70% undervalued. And if you buy right now, you can expect a CAGR of 22%. This is a golden opportunity for those who understand MSCI, for those who understand the moat of this business. Okay? The stock is down because other analytics companies have reported slowdowns like FactSet, for example, or Moody's, all the industry in the software department. You have critics saying AI will disrupt this business. Can be happening. It's a risk. AI can disrupt MSCI, but I don't think so. I think AI will help MSCI because they will be able to do the same amount of work with fewer employees. So there is and that's not priced in by the market. There is a scenario with a non-zero probability where MSCI becomes even leaner with margins that go even higher because they implement AI, they grow free cash flow, revenue, earnings with the same amount of employees. So the revenue per employee will skyrocket. Free cash flow per employee will skyrocket. You don't need to be a genius to run MSCI. I mean, it's been the same business for years and years and years. The CEO understands this. So you don't need a lot of staff. You don't need a lot of team. You just need to be efficient. And in the latest call, they said they are embracing AI to become even more efficient. So I think margins will go up. And if margins will go up, there is a scenario that is possible, but I'm not betting the farm on this one, right? This is why I started the DCF with conservative assumptions. But there is a scenario, the bull case. What if, instead of growing free cash flow 17%, the business is accelerating, become lean, efficient, fast growing? What if they grow free cash flow at 20% per year? I'm not sure this will happen, right? Don't put comments below saying you are too optimistic. This is just, let's say, a 5% chance of happening, 10% chance of happening. This is unlikely, but just in case, because it can happen. What if the free cash flow is growing 20% per year? They are continuing to do a 3% buyback every year, and the price to free cash flow is 30. If these are your assumptions, if you buy right now, you can expect a CAGR of 24%. But you know how markets work. You know that if a business accelerates, the multiple will go up. If a business is sustainably growing free cash flow at 20%, it will deserve a higher multiple, like we've seen before. Like if you have a re-rating to the upside, the price to free cash flow will not be 30, but it can be 35, maybe 40 to a very extreme bullish scenario. That would mean a CAGR of 30%, but let's put 35. It's more than reasonable. If this is your bull case, if you buy right now, you can expect a CAGR of 27%, and you will outperform everybody. Yeah, I like the odds of this one. I like the resiliency of this one. I like the way management thinks about buybacks, about capital allocation, about being efficient. And I think for the next 10 years, MSCI will be in a very comfortable position. Okay? So this was for the first stock I wanted to talk about, and the one that I am most bullish on. The second stock I want to talk about is more boring. It's a Korean company called Gravity, and they do online games, mobile games. You play on the phone, smartphone, fantasy games. They've had the same games for 20 years, the Ragnarok license for 20 years, since 2003. And now the company is very cheap, okay? It's a company in Korea that is listed in the US. So you can buy it from a US broker. And this is a profitable company. And they have a lot of cash. Now they have as much cash as their market cap. You don't have a lot of opportunities like this in this market. And I'm following the Asian markets. I'm following what is happening in Japan. I'm following what is happening in Korea. You have more and more regulators, financial regulators, that are forcing companies to reward shareholders. So you have increasing odds that Asian companies like Japanese or Korean will be forced to use their cash to show investors how they will use their big balance sheet filled with cash to reward shareholders. Actually, as I'm recording this video, today you had a new law in Japan saying it's now mandatory for companies in Japan to show what they will do with their cash. And it's the first time in 5 years a new regulation was passed like this. So what is happening is big, what is happening is massive. And in case the same thing happens for Korean stocks, Korean companies, they will be forced to use this cash. The big question mark is you don't know when. When will this cash will be used? When will this cash be used to do dividends or buybacks? Nobody knows. But anyway, if you look at the cash of this company and at the same time you look at the market cap, what can you see? You see that every time the company, in orange you have the market cap, in blue you have the cash balance, okay? Every time the company, the stock price dropped, it rebounded to the cash level. That's a support every time. You can see 2018, 2020, 2022, 2024, March 2025, and right now, if you look on a quarterly basis, the same thing. You will find the market cap of the company always rebounding to the cash level. And now the chart is not updated. You have a price, the price, the orange line, the market cap updated up to October 7th. And since October 7th, I'm recording this video October 20th. Since then, this is, how can I show you? Gravity stock. How can I show you? Let me put in English so you see better. October 7. Here we go. Since then, the stock has dropped 5%, 4%. So the downfall continues. And we just reached this bottom again. We just reached the cash level. This is why on GoFocus, you see a market cap of $400 million and an enterprise value that is negative. Now, as I'm recording this video, this is a company that has more cash than the entire market cap. And since 2017, 100% of the time this company was trading at cash, it was the rebound. It was the bottom. Maybe this time will be different. I would not bet that this time is different. Nothing has changed for this company. As long as this company is profitable, nothing will change. The company has turned profitable in 2017 because they shifted from desktop games to mobile games, and it is now much more profitable. And since 2017, since they have become profitable, every time it's rebounded to cash level. Now we are in a market that is overvalued in the US. The markets are expensive in the US. Maybe you want some hedges in your portfolio. Maybe you want some safe assets that will not have a huge reward on the way up, upside potential, but you will have a limited downside protection. And I bought Gravity for the downside protection. And also, I want to buy more Gravity because it just reached cash level. And you don't see many opportunities in the US actually. I mean, you have MSCI, you have a few companies that I'm buying right now, but you don't have many opportunities. A lot of things are overvalued. So maybe some diversification, hedging, Korea. This is pretty smart way to allocate your portfolio, I would say. Because of this, because of the safety, balance sheet, and also a call option on, how can I say it? Activism from the government. If the Korean government wants to implement new laws, you have a new president in Korea that is much more shareholder friendly. They want the Korean index to reach a very high level. They want to almost double their equivalent of the S&P 500 over there over the next few years. So literally, the government in Korea is following the Japanese government. What the Japanese government has been doing since COVID, I would say. Literally, word for word, they are following each other. And it has worked beautifully for Japanese stocks. There is a reason why Warren Buffett invested in Japan in 2020, in August 2020, I think. You start to see shareholder friendliness in this region. And I told you, today you have a new law, the first time for the past 5 years, a new law that was released to the regulators. Companies are now forced to announce what they will do with their cash. They can do stupid things, but now they have to do something. They don't have to hoard a fortress of cash in your balance sheet that will yield less than 1% in Japan. No. Now you have to announce what you will do. Maybe acquisitions, maybe buybacks, maybe capex, maybe dividends, but you have to do something. The same thing will happen in Korea, but you don't know when. Okay? So that was for the second company. Excessively cheap. You have a company for free right now. You buy the company for cash and you just wait. The third company I want to talk about is a company with the stock price that is dropping again. That's Landbridge. Landbridge, if you don't know this company, they own lands in Texas. It's a royalty business. 80% margins. Look at this. Gross margins of 90%. We are talking about a very profitable, wide mode, efficient machine that has very good chances of growing 15% per year, 20% per year at zero cost, at zero capex. You don't find a lot of these opportunities, right? It's like TPL, Texas Pacific Land, and I made a fortune out of TPL actually. I've been investing in TPL for years. I sold at the top. I made almost a 10x on TPL. And I see the same attributes I saw for TPL. I see the same attributes for Landbridge right now. And Landbridge is similarly in Texas, they own lands, and the stock has dropped. Okay? And as the stock price is dropping, I am buying more. Now, the stock is dropping because people expect data centers to be built on their lands. And when the stock price is high, the company is announcing new deals. Maybe you will have a data center on our lands in Texas. And then no news. So people are disappointed and they sell their stock. And then the stock falls and falls and falls. And people are bearish. They don't think a new data center deal will come. And then you have a new piece of news saying the data center will come. The stock goes up. The sentiment for Landbridge is very fragile because I've made other videos on my channel about this one. People don't understand Landbridge. The stock price of Landbridge follows oil prices. Okay? You have a strong correlation. When oil is down, Landbridge is down. But less than 10% of the revenue for Landbridge is linked to oil. Can you answer my question? Why is the Landbridge stock price correlated with oil prices? That's a question that I find very difficult to answer. The first answer to this would be Landbridge is very much correlated with TPL, and TPL follows oil prices. So it's a correlation of a correlation. Fair enough, fine to me. And now oil prices are at $50. I mean, very, very low, $50, $60, very, very low. And as you can see, for the past year and for the past year, look at this. I'm showing you Landbridge here. Stock price is oscillating down and then stable. TPL, Texas Pacific Land, oscillating down, stable. You have a very, very, very strong correlation between these two companies, and TPL is following oil prices because it's a royalty business for oil prices. So it makes sense for TPL to follow oil prices. But what about Landbridge? Only 10% of the revenue is linked to oil. The rest is water. So we don't care about the price of oil. You have more pumping, more drilling, drill baby drill in the US, so you have more volumes, so you need more water, so Landbridge makes more money. It's a royalty business based on water. So you don't have a lot of data for this company because the company went public, IPO, in July 2024. You don't have a lot of data. You have a few reports here and there. I think I have followed everything on the internet regarding Landbridge. Like, I don't know any other YouTuber that has done the kind of work I did for Landbridge, and I am buying more as it goes down. So it is quite telling. If you want to know if I'm still bullish the company, yes. Now the stock price is dropping and the management team is very aggressive. They just announced an acquisition of new lands. They just announced a deal for for solar panels with a commitment of a few $1 million. And very recently, you had a new deal of a large data center in the Permian Basin in Texas. So now you don't have a lot of deals for Texas data centers here. The thesis is eventually data centers will come. And in the latest earnings call, Landbridge, let me show you what I mean. Let me show proof of what I mean so you don't have to do the work yourself. If you check the latest earnings call for this company, August 2025, you have the last question from Larry Goldstein that says, here it is. Larry Goldstein, here it is. Good morning. If you don't know Larry Goldstein, he manages a fund called Santa Monica Partners. He has been a shareholder of TPL, Texas Pacific Land, for more than 70 years. 70 years, 7-0. So he has made a fortune out of this royalty company in Texas. And he just bought Landbridge. Quite telling, right? If you have the longest shareholder ever for TPL that is now getting interested in Landbridge, that is now asking questions to the management team, quite telling. So he has a question about why don't we hear a word about data center? Why don't we hear a word about data centers in the Permian Basin? Okay, so we hear a lot about AI data centers, North Virginia, etc., etc., etc. Why don't you have a lot of demand for building data centers in the Permian Basin? And the answer for the management team is, for now, we don't see demand, but in the future, we are bullish, people will come. And to that, Lawrence Goldstein says, I don't believe you. You don't have a lot of population. The land is so empty. You don't have population, so I don't believe you. To that, management said, yeah, I understand, but eventually data centers will come. And this is the end of the discussion. So Larry Goldstein, biggest bull ever for TPL, is having doubts when it comes to the thesis of data centers for Landbridge. But he is still buying, and I'm monitoring his portfolio. So, very interesting situation. Let me put it this way. And even if the data center never comes to Landbridge, even if the thesis never comes, Landbridge, with their water segment, can grow revenue, earnings, free cash flow at 15 20% per year. Because I know this business very well. It's the same business model as a TPL for their water segment. If you want to check more information about this, you have a fund called Horizon Kinetics that is the biggest shareholder for TPL, that is the biggest shareholder for Landbridge. They own both companies and they are focused on royalty companies. They have made plenty of interviews explaining the business model of Landbridge that very few people understand. And they say clearly, yeah, maybe we will not see data centers, but this is a royalty business in the water segment with zero cost, zero capex that can grow and that is now growing minimum 15% per year. Even if you don't have data centers. What if you have one data center that comes? You will grow by more than 15% per year, 20% per year, okay? And the valuation for Landbridge is not so expensive right now because the stock has gone down. The stock has gone down. Landbridge, no, that's not the good one. The market cap is around $4 billion. Okay, let me calculate it. Be careful on different websites because look at this. In GuruFocus, you have a market cap of $1 billion. That's wrong because you have two class of shares like Google. You have class A, class B, class for the insiders and class for us retail investors or other people. And on GuruFocus, they don't take into account all the class of shares. The real market cap of the company is shown on Stock Unlock. And on Stock Unlock, $4 billion. Now the company has a guidance and they have very good chance of managing $120 million of free cash flow. Which means if I divide 4,000 to 120, you have a price to free cash flow of 33. So 30, 35 for a business that can grow easily at 15% per year. For a business that can grow easily without any cost. Now, we are living in a world with inflation, right? You know, people lie about the inflation data, etc. It's more than 3%. Okay, everybody agrees we have inflation now. If you think you will live in a world with sustained high inflation, you want inflation hedges. Landbridge doesn't have any cost. So all the revenue growth will be translated to free cash flow. And they can grow even without data centers, grow at 15%. Even if that's not 15%, you grow at 10% per year, pure profit, gross margins of 90%. At a price to free cash flow of 30, 35. I find this very reasonable. What if they grow more than this? I have followed the TPL for more than 10 years now. What if they grow by more than 15% per year? 20% per year? What if oil prices go up again? It will be an additional boost to Landbridge actually in the short term. What if they announce a new data center project? You have so many call options when you buy Landbridge. And we don't know if the valuation will continue to go down. Maybe the valuation will come down to a price to free cash flow of 30, 25, 20. It can. And if it does, I will buy more. So these were three companies, three stocks that I think are undervalued to buy now. If you like this content and you want to go deeper, I have a coaching program. In this program, you will learn the strategy I use to outperform the market. You will learn how to find winning opportunities. You will learn how to properly value stocks, when to buy, when to sell, so that you can build a strong portfolio with great companies. Additionally, inside the program, you will have access to an exclusive community of like-minded investors, and you will also have access to my personalized guidance to reach your investing goals. Click the first link in the description to get more information. You will get a short video that explains how everything works, completely for free. No need for your email address, just click the first link in the description and I'll see you on the other side.